In this video, we will discuss why it is important to identify the top of a bull market and how to identify it. So, why it is important to identify bull market top? Because the bull market top is also the end of that bull market. And now bear market will start and price fall will be very sharp, quick, and brutal. And more importantly, market will only fall from here. And market would fall anywhere between 40 to 70% in matters of few months. And what we have earned, what we would have earned in last few years will get wiped out in just few months. So see, this is how bull market rises. And finally, there is a top. And once the market has made a top, there would be a severe fall, which will create a shock. And then there would be a rise, which would be more like a bull market rally. And that will create a hope that no, market is still fine. But after that, again, market will fall further down. And this would first create denial, and then it will create a self-bashing. I should have sold at the previous high. And market will again give a rise, and this will again create a hope, and hope would be a weak hope, but there would be a hope, and market would fall further down, and now mind will accept. It will realize that it is no longer a bull market and bear market has taken control. And once we realize that the pain of loss, we can't handle it, and we say that, okay, I will exit. And this may be the bottom of the bear market. And this is actually the golden opportunity to invest. So not only we will lose a lot of money, we will also miss the golden opportunity to invest if we don't exit at the top of a bull market. So if we don't exit at the top, then we will not be able to exit when market is falling because there would be hope. But that hope will turn into pain and self-bashing that I should have sold in the previous high. This is how it will happen. Let's say your portfolio is 1 crore at the top of a bull market. That's your portfolio value at the top. And then after 20% fall, which will happen very quick, very sharp, you will have the shock, and then there would be a rise and portfolio will rise back to 90 lakhs and you would be in hope that no, everything is fine. But again, there would be a fall and market would fall to, your portfolio value will become 70 lakhs. And you will say that I should have sold at 90 lakhs, And then again, there would be a small rise. Your portfolio will become 78 lakhs. And you would be in hope that no, it will go further up. And then it will fall further and it will become 60 lakhs. And again, you will be beating yourself that I should have sold at 78 lakhs. So see, now what has happened is your whole focus is on reducing loss. Forget about making money and growing portfolio, how to reduce loss. And mind will keep on this kind of trap. And finally you will see that your portfolio has become 60 lakhs, which is 60% down from 1 crore. And then you will say that, I can't handle this torture anymore and I will exit. And then you exit. So let's look at the difference in our experience and outcome in two choices. First, if we don't identify the top and exit versus if we could identify the top and exit there. Okay. So if we don't identify the top, then we will find ourselves in the bear market when price has already fallen. So we would incur huge notional loss and painful experience. And if we panic and exit after 40, 50, 60% loss, then the actual loss will be huge. And we will also miss the golden opportunity to invest at the bottom because that is when you are exiting, right? That too at a huge loss. Versus if we could identify the top and exit there, then we will be able to protect our capital and profit both. And the whole fall of the bear market will be a happy experience because you will see that market has fallen 10%, 15%, 20%, and you would be happy that your capital is safe. And finally, you have the opportunity and the frame of mind to invest back in the market when market has fallen by 40 or 60%. So that is why if we could identify the top and exit, that would be very, very positive experience, both in terms of our psychological status as well as our financial status. So we need the ability to identify the top of a bull market. And we also need clarity, conviction, and willingness to exit then if we identify the top. So let's look at how does bull market peak. So what happens is in a bull market, economy is in a virtuous cycle. There is a demand for product and services. Because of that, there is increase in sales and therefore increase in profit. And companies, they want to increase capacities, they want to make new factories to meet the demand. Because of that, there are more jobs in the market, the salaries are getting higher, promotions are happening, and because of that, consumer confidence is very high, they are willing to spend, and banks are happy to lend both to individual retail people as well as to companies. And that further fuels the demand. So it becomes a virtuous cycle. And at the same time, stock market is also in a virtuous cycle in a bull market. So price is rising, stock price is rising, and people are using margin money and derivatives to leverage their positions. So a lot of people are making easy money, big money. There is bullish news everywhere, and it is creating FOMO in rest of the people who are conservative, who have not invested, and they start investing, and that increases the buying, which further increases the price rise in the market. And also remember that economy is also doing well, and quarterly results of companies are coming out great. So that is also fueling the market sentiments. But at the same time, after some time in a bull market, excesses start getting built up in economy as well as in stock market. So in economy, what happens is that excess capacities are getting built to meet the increased demand. And leverage is also increasing. Banks are giving loan, companies are raising capital, and inflation is rising because demand is so high. And in stock market, prices are overvalued. There is a lot of leverage based trading happening. Everyone thinks quick money, easy money is there. FOMO is spreading in the market, and there are stocks, the bull market leaders, which are doubling every few weeks or months. So these excesses are getting built up, but we are too busy to notice it. We means individual retail investors. Why? Because we are happy that our portfolio is rising, our profit is increasing, and we are we are confident that everything is fine because there is bullish news everywhere. And when we have a choice to feel happy about everything going good, we don't want to worry because worry is painful to the mind, right? Because we can't choose to be happy and worry at the same time, you know. So there is a bias towards not looking at what could be wrong in this particular situation where my portfolio is rising every month, every few months. So what is happening here is there is a strong economy. Companies' profits are soaring. Stock prices are going up. There is bullish news everywhere. And there is FOMO getting created by people looking at their friends, relatives, everyone is making money. So that starts feeding each other basically. Because strong economy will lead to companies' profit, and profit will lead to stock prices going up. Bullish news will be there and it will increase the FOMO. So all this start feeding each other, and because of that, more and more people start investing into the market. Newer people start coming into the market. And a time comes when there is a euphoria in the market. Okay. Euphoria, what happens in euphoria is that everyone gets sucked into the market. It's like a fire in the jungle. So a time comes when chai wala, pan wala, sabji wala, everyone is talking about stock market and they are also investing there. You will see that most skeptical person will also start investing in the stock market. And everyone who can invest, they start investing in the market at the peak of the market. And this creates a rare opportunity for professional money with very large holdings. So there are professional people with very large holding, 500 crores, 2000 crores, 10,000 crores, and so on. So this professional money, they have a limitation that they have very large holding. So they can't sell their holding in a normal market because market will not be able to absorb their large quantity, and market will fall big even before they could sell their position. So the only alternative for them in a normal market is to go for a negotiated block deal or large deal through a fund manager or an institutional investor. So whenever a fund manager or institutional investor is going to buy through a negotiated deal, he or she will not pay such a high price over valuation, right? Whereas market is currently clearly overvalued at the peak, at the top, right? So this situation where market is at the peak, clearly overvalued, and there is a euphoria in the market, means everyone wants to buy. So this situation where so many people want to buy into the stock market, it creates a huge demand. And this huge demand is the opportunity because now they can sell their large position at a such high valuation. So now professional money will start selling. So professional money is selling because they know market is overvalued. They have seen excess in the economy as well as in the market. And this is the only time when they can sell their large holding at such a high price. So it's a rare opportunity for them. So professional money will start selling, others are buying. This is called distribution at the top. And this is a clear sign that bull market has peaked. This is the top of the bull market. That is what we want to identify. As and when it happens, that is what we want to identify. That is the purpose of this video. So let's see. Once professional money has sold their holdings, bear market will start and market will fall big. Why? Because once professional money has sold their large holdings, they will withdraw from the market, means they will stop buying further to support the market. And when professional money is withdrawn, market does not have much support. And remember, most of the retail investors already got sucked into the euphoria at the top. So most people have already bought. You have limited money, you have already invested at the top. You have no more money left. So most retail investors are already, they have already invested the money they had. So there are not many buyers left in the market. And when not many buyers are left in the market is very vulnerable, because if there is a fall, the fall could be very big because there are very few buyers. So any bad news or short sellers will be able to bring the market down very significantly at this point of time. And then vicious fall will start. And it will be vicious because when market is falling, there will be a self-reinforcing loop which will get created. So price is falling. So stop loss will get triggered for many people, means they have to sell. Then margin calls will also get triggered, which also means that they will have to either deposit the money or position will be squared off, more selling. Then short sellers will become active in the market. Once people realize that market is weak, professional money will start selling, short the market. And if market falls big, then exchange would increase the margin requirement for the broker, and broker will increase the margin requirement for the investors, which will lead to further margin call and further selling in the market. Mutual funds may also face redemptions, and FII might start selling, which could weaken the rupee. And if rupee gets weakened, FII will start selling more because they want to quickly come out of the losses. And then negative news will start surfacing as to why market is falling and what is wrong and so on. So all this will start feeding into the price fall. And remember, there are not many buyers left in the market and professional money has withdrawn. So market will fall big, and market will fall 40 to 70% in few months. So now we have understood the theory part of it. Now let's come to how to actually identify the top, the distribution, when professional money is selling. So three things are important. First, market should be all-time high, well above the previous high. Second, volume should be ultra high, not just above average. It should be ultra high. Third, that price is not moving up meaningfully. despite being volume, despite volume being so high, the price is not going up meaningfully in the market. All three conditions are important. That market should be all-time high, price should be ultra high, and price is not moving up meaningfully. So the logic is when there is such a high volume at the top, ideally price should shoot up further because there is so much of buying, right? But if price is not going up meaningfully, that means the bigger players are selling there. At every opportunity, they are offloading their positions to retail investors. And that is a sign that market has stopped. So if we look at it, we will be able to find that this is what is happening. But it is not easy because there would be bullish sentiment everywhere. Remember, economy is still doing well. Companies' results are coming out fine, good. And you would be sitting on large profit. It's top of the bull market. And mind is happy expecting more profits in the future. Your portfolio is doubled and you are thinking that it will get doubled from here also. So you don't want to worry about the potential fall in the market, I have already made money. I have cushion, right? So you cannot afford to be complacent here. If you keep thinking that, I have already made profit, so I don't have to worry about, that is the state of being complacent. You cannot afford that. What we have to do is the first requirement is to not become complacent. Becoming complacent means mind says that, okay, my portfolio got doubled, so I don't really have to worry about if there is a small loss. I can afford to lose, you know. The second is we have to train our mind to not trust news and experts blindly. Because most of the time, the media, the news, and experts at the peak of the bull market will justify the price and probably give a higher forecast of further market going up. And then we have to actively look for distribution. Because the first two, if we have this state of mind that we are complacent, then our mind is not worried. And if we are not worried, then we are not going to spend effort in looking for distribution. So these two conditions or these two state of mind where we are complacent and we are trusting the media and news and experts, then we will not even look for distribution because we are not worried that market could fall. So not becoming complacent when market is all-time high is the first trait which we have to build. But at the same time, we have to be careful when we want to apply this understanding that we don't want to act based on anticipation that this is the top or top is very near, so why wait for top and let's exit. Do not exit until you see clear evidence of distribution. We have to see, not anticipate, because the market can even double from here. It can go to any extent. Bull markets are always unpredictable in terms of they always exceed the highest expectation of most investors. But once we see the distribution clearly, once we see it happening clearly, then we have to exit or at least do partial exit. Do not listen to your mind because mind is based on emotions and feelings. And for God's sake, do not delay exit to save tax. Do not be that stupid. Once you have seen this is the peak, this is the top of the bull market, may exit or at least exit partially. I would minimum exit 50%. So let's recap what we want to do. We have to take care of three things. First, do not become complacent with profit and do not trust news and experts when market is at the peak, when there is a euphoria. Second is look for distribution. Distribution, how to identify distribution? That market should be all-time high. Volume should be ultra high. But despite volume being ultra high at all-time high price is not moving up meaningfully. This means market has peaked. All three conditions together should be satisfied. And once you clearly see that, then exit. Do not listen to your mind once you have seen distribution. Do not allow your mind to decide here. Don't think that I have made so much money, so let me wait, I can afford to lose some money. After the top, do not give freedom to your mind. It will quickly turn into a loop of hope, denial, pain, and loss. First opportunity to exit is the best opportunity to exit. Happy investing. Hope you found this video useful, informative. And there is a standard disclaimer that this video is made only for the education purpose. Please consult your investment advisor before taking any investment decision. Thank you.